Hello. Thank you for watching our Tesla Motors company analysis here at the University of Central Florida. If you have not yet heard of the world's first fully electric luxury vehicle designed and produced in the California Silicon Valley, then this presentation just might reshape your idea of the modern American car. Before we go into a detailed analysis, here are a few facts about the firm. The company was founded in 2003 with its headquarters in Palo Alto, California. It designs and manufactures electrical vehicles as well as EV powertrain components. The Tesla factory is located in Fairmont, California. Its design and advanced engineering facility is in Hawthorne, California, and the Tesla assembly facility is in Tilburg, Netherlands. The current CEO and co-founder, Elon Musk, often described as the Steve Jobs of the auto industry, had brought his computer programming expertise and visionary convictions first to X.com, which was later sold to eBay as PayPal for $1.5 billion. In 2002, he founded SpaceX, which manufactures and launches advanced commercial rockets and is currently developing a Mars colonizing initiative. Tesla is quickly gaining international recognition for both of its strategic business units. Its Model S vehicle is the only fully electric vehicle on our planet, capable of going 300 miles on a single battery charge and accelerate from 0 to 60 miles an hour in 5.6 seconds, all while providing almost noise-free comfort and zero emissions. Tesla's proprietary engine, chassis, and transmission subassemblies, developed fully in-house, have attracted key industry players like Toyota and Daimler. Tesla's macroeconomic environment is multiplex, with extra layers of complexity arising from its EV pioneering position. The growing consumer sentiment towards ecologically friendly practices perfectly fits the firm's differentiation efforts. Tesla offerings are entirely unique in their design and functionality, requiring a completely new charging infrastructure and real-time engine software maintenance. Economic factors are also in the company's favor. Forecasts of steady GDP growth, decreasing short-term financing rates, quickly depleting supply of crude oil, and rising gas prices will allow Tesla to borrow cheaply while fulfilling the need for fossil fuel-free, affordable transportation for our future generations. In addition, the U.S. government has been encouraging green innovations and manufacturing processes with increasing subsidies and tax credits. After filing for incorporation in 2003 in Delaware, the company must follow those Delaware Blue Sky laws, which currently do not pose limitations on mergers or acquisitions. However, Tesla is unable to operate its direct customer sales stores in New Jersey, Arizona, and Texas. Most states mandate that vehicle sales must be made through third-party dealerships, while Tesla's strategy is aimed at direct customer sales. In spite of being a leader in EV engineering, Tesla only accounts for 1% of the total U.S. auto market. Its auto manufacturing SBU is expected to grow substantially in the near future due to increasing brand recognition, international market penetration, and new mass-market model offerings. Its two main competitors, General Motors and Toyota Corporation, hold 18.6% and 18.9% market share respectively. GM's Chevy Volt and Toyota's Prius line are Tesla's direct competitive models. Tesla Motors has recently gained 8.4% market share in the luxury F segment. Its Model S was voted the best-selling car in 8 of the 25 wealthiest U.S. zip codes. These are clear indicators of successful strategy implementation and precise, elite, eco-conscious customer targeting. Tesla's most critical supply chain constraint is battery cells. Its main supplier, Samsung, currently on target with 2 billion cell deliveries, may not fulfill Tesla's requirements for mass production. To mitigate any bottlenecks, Tesla plans to build gigafactories in 2014 and establish partnerships with mining companies. In March 2014, Tesla raised $2 billion through a convertible bond offering. Its $31 billion market capitalization has given the firm considerable financial leverage power. When it comes to human resources, the company's ability to attract talented employees is based on their reputation as a fast-paced, boundary-breaking company that believes in high risk and high reward. It currently employs over 6,000 specialists for its 100-plus retail stores and R&D facilities in over 31 locations worldwide.
Tesla believe it can lead a revolution and change the face of motoring forever. It's the first ever mass-made premium sedan powered purely by electricity. Designed to have speed and range and not a drop of gas.
Our goal is to create an electric car that is the best car in the world and show that that's what an electric car can be.
Tesla's main goals momentarily include continued growth through expanded supply chain and increased production capacity in its gigafactories, boosting brand recognition and enhancement in customer service level through additional retail and service stores, and most importantly, continued progressive investment in supercharging infrastructure. These goals are closely aligned with the company's generic differentiation-focused strategy, aimed to better meet the needs of their current elite target customer. Tesla's grand strategy includes both product and market development in concentrated growth. Its future Generation 3 products like Model E are being developed for mass markets with better driving at a lower price in mind. A closer look at the SWOT analysis reveals a broad array of the company's strengths. Among them are Tesla's unmatched EV tech expertise, current large production capacity, highly differentiated product offerings, in-house component development, strategic partnerships with Toyota and Daimler, as well as a very experienced management team. A key strength of the Model S platform is its cross-utilization in Tesla's Model X and future Generation 3 vehicles. Such component standardization is expected to drive production costs down. Tesla's current economies of scale, low sales volume, higher product prices, limited battery range, and reliance on a single supply source and single target market are among current weaknesses. However, many regard these as inevitable in a young, successful company's evolution. While pursuing their long-term growth and expansion strategy, Tesla should keep in mind increasing fossil fuel prices, a growing domestic market, as well as immense potential from international markets. Rising environmental consumer awareness is expected to stimulate government support for green technology, while future product line extensions are to facilitate B2C sales approvals. Although Tesla is the current leader in EV design and R&D, key industry players are aware of future trends in consumer tastes and raw material supply. All competitors intend to enter the EV market sooner or later. Once combustion engine efficiency is at its peak and crude supplies are depleted, the company will heavily rely on its ability to innovate and provide safe energy powertrain sources. Porter's 5 Forces framework indicates high and increasing competitive rivalry within the auto industry. Barriers to entry into this mature and highly saturated market are high. Even to consider entering a niche EV market, one would have to face the size of industry key players. Capital intensity, high technological expertise, human resource and logistical requirements, coupled with the absent EV infrastructure, make the industry unattractive and almost impossible to enter. Threat of substitutes is low. All current market alternatives like hybrids, hydrogen, diesel, natural gas, and flex fuel vehicles still either require some fossil fuel source or lack in performance. Besides, hydrogen and natural gas vehicles require a new complex infrastructure, whereas Tesla vehicles are being integrated into the smart grid. Abundance of battery and component suppliers, low switching costs, and Tesla's self-reliance on in-house R&D make the power of suppliers low. Model S uniqueness and almost perfectly aligned differentiated offering make it impossible for customers to find an alternative that combines prestige, eco-consciousness, luxury, and performance into one vehicle. Low competition and value-added services stimulate loyalty to the brand and secure future high-priced purchases. Majority of Tesla's revenue comes from electric vehicles, with electric powertrain systems accounting for only 2.5% of total output. After reaching their production capacity for their Roadster model in the US market, the firm's only current product offering remains the Model S. The electric vehicle SBU revenues increased by 71% and 82% in 2012 and 2013 respectively. However, the company's powertrain systems SBU revenue dropped 33% in 2012 and increased 30% in 2013. Boston Consulting Group's growth share matrix reveals an undiversified portfolio with both Tesla's SBUs as question marks. This is indicative of their high growth rate and profits, yet very low but growing market share and negative cash flow. Future performance would reveal growth potential and SBU retention approaches. Under the McKinsey & Company's business strength matrix, both product lines fall under the challenge category due to their increasing industry attractiveness and progressively fortifying business position. As both matrices show, Tesla should continue to invest in their 2 strategic business units in order to increase growth and profitability of the company. Supporting customer service activities, including retail stores and supercharging infrastructure, must be implemented in alignment with product development to ensure brand recognition and liberal product diffusion. When it comes to strategic control, Tesla Motors implements the premise control, which is focused on operating environment factors like technological breakthroughs, crude oil prices, regulatory, political, and labor conditions. In addition, industrial factors like competitive intensity and supplier dependence require monitoring. The Special Alert Control monitors extreme conditions like natural disasters, political unrest, and hostile takeovers. For instance, Tesla classifies a battery malfunction which could cause hazard to its customers as a special alert. It is the only vehicle on the market with 0 injuries or deaths and is rated the safest vehicle on the road. The company's implementation control still remains unclear due to Tesla's short operating history and continued internal evolution. Product quality and service level consistency show that processes are in place, but no clear approaches have been revealed or observed. Strategic surveillance is a key control feature in the auto industry. It is imperative that the company continues to monitor trade publications, attend conferences, and closely examine competitors' technological intent. Despite the history of operating losses, Tesla's 23% gross profit margin is higher than industry average, a strong indicator of advantageous production processes. The company's operating and net losses are attributable to high operating, administrative, and R&D costs. The leverage ratio of 3.62 is up to par with the industry ratio of 3.56, showing that Tesla maintains a similar balance of debt and equity as the competition. Greater than industry average current and quick ratios reveal the company's strong liquidity position. Tesla's inventory turnover of 5.22 can indicate operational issues and can result in high carrying costs. The company had year-on-year revenue growth of 387% and a 3-year revenue compound annual growth rate of 158%. The strong revenue performance is indicative of the growth stage. The company's financial position has been improving, and in 2013 there was a 384% increase in cash and 116% increase in total assets. In an effort to provide the most optimal recommendation for Tesla Motors, we made some important assumptions. On a macroeconomic level, we assume that the rising price of fossil fuel, growing eco-awareness, and a drive for cost-effective transportation will stimulate demand for electric vehicles. Also, it is assumed that political, geographical, and economic risks will remain constant among all industry layers. At a firm level, it is assumed that Tesla would continue to invest in cutting-edge technology and efficient manufacturing processes, which will promote continued sales growth. An important aspect is also that Tesla's brand and service level would not be diluted by expansion. The critical nature of logistical reliability is especially true for auto manufacturing firms, where missing a single component can hold up an entire factory's production and result in lost throughput and inability to fulfill customer orders. For this reason, it is important to address the structure of Tesla's supply chain, including its weaknesses of single-source components and overall complexity. Our proposed recommendation is a 3-stage strategic sourcing plan to address current weakness and position the firm for explosive growth in production requirements. First, Tesla should develop new supplier relationships to eliminate single-sourcing components. Next, the company should seek suppliers who provide multiple components to allow network tier consolidation. Lastly, the firm should increase downstream supplier interaction with strategic alliances or joint ventures in order to reduce material costs. Some key advantages resulting from this approach include elimination of single sourcing of components, which on the other hand would increase the supply chain complexity. Tier consolidation of suppliers, which would reduce markup and material cost, but will require time and cost investment to develop new supplier relationships. Decreased risk of supply interruption due to improved contingency plans, and greater overall control of supply through joint ventures and strategic alliances. The proposed solution improves the competitive position of Tesla by reducing the threat of production downtime, ensuring ability to handle increased production volumes and reduce material costs. While seeking out additional suppliers to reduce single-source components will add to the complexity of supply chain, it mitigates a major risk of sustainable operation. In the second stage, Tesla will work to consolidate suppliers into multiple component providers, which will allow them to leverage volume buying, reduce transportation costs, and ensure material availability. The final stage of the solution will be important for long-term success in the electric vehicle industry, since strategic alliances or joint ventures will allow Tesla to have greater influence on technology, costs, and accessibility of its downstream supply. The overall impact on Tesla will be a sustainable platform to meet its future production needs in the growing eco-friendly auto market.